Hey, it's Lon Welsh at Ironton Capital, and thank you for joining me today to talk a little bit about the initial launch of National Diversified Fund 10, or I'll call it NDF 10. And our target is this is going to be a 4 to 6 year hold with about a 16 to 20% annualized return. So many of you have got stocks and bonds in your portfolio, and you've got an interest in getting diversified into real estate, and you've wanted to achieve this without having the headaches of actually buying a property and managing it yourself. So we're sort of the easy button for getting access to passive real estate and a great return that will build over the long time. First, a quick note from our attorneys. There's a lot of confidential information in this presentation, so it's for you and your CPA and financial planner and your other advisory team, but please don't distribute it beyond that. Any type of investment in real estate involves some risk, so you want to make sure that you assess all of this with your financial team before making an investment. Today's discussion is not an offering of an investment opportunity. If you are interested, we would be delighted to share with you the legal documents, specifically the private placement memorandum that goes through all the risks and all the things you want to consider before committing to an investment. Today's discussion is going to have a lot of forward-looking statements. So you're going to hear me say things like may, will, should, expect, plan, seek, intend, anticipate. And these are all based on our best information with our analysis of the market, information that we've gotten from the sponsors, and our analysis on all that. You'll want to do your own analysis, develop your own point of view before making an investment decision. And finally, there's a lot of company-sourced information in here. Some of it is third-party, like from CoStar. Some of it is from the sponsors. Some is our independent analysis, and we've sort of synthesized all that to present to you what we have today. So when you leave the heavy lifting to the experts, you're going to feel like you've taken like a load off your shoulder, that you're not having to try to manage all these little investments yourself. So we have 4 broad offerings at Ironton Capital that can help you in building either a legacy for your family down the road, or your philanthropic interests, or maybe it's just funding your retirement. The first major group of things we offer is our National Diversified Fund. That's what we'll talk about today. Those are usually a 4 to 6 year time frame, more than a 16% annualized return. No liquidity, though. We do have some options for tax shelters with that. Then we have a short-term and a medium-term income fund. The short-term fund has got great liquidity, and it pays between 8 and 9%. The more you have invested with us, the more it pays. And that's taxed as a REIT, a real estate investment trust. So usually for many of you who are high income earners, it'll be a more favorable tax handling. Definitely talk to your CPA about that. The medium-term fund pays between 11 and 13%. And that's also quarterly, just like the short-term fund is. No tax advantage. It's locked up for a year, but then it's got quarterly liquidity after that. And then finally, every once in a while, we'll have a single asset fund that's really interesting. Don't have any just at the moment, but stay tuned. Those do pop up periodically. So the standard practices of working here at Ironton, we're focused on servicing accredited investors, and I'll define that in a little bit, who are typically underserved by wealth management firms. What we tend to find is that when you get to have more than, say, $30 to $40 million under management, you can get a different sort of a team that not only will be an expert at stocks and bonds, they'll also be really good at real estate and picking out, platinums and other commodities, and help you really build a great portfolio. A lot of the people that we work with are in the $1 to $10 million range, and they don't have the option of having a large advisory team serving them, and their current financial advisor is often usually just focused on stocks and bonds. So we're a way to get access to real estate in a highly diversified and cautious way, so that you can round out your portfolio without a lot of brain damage. The general partners invest with you. We've got a long track record of doing all this work. The GPs get their profits after the limited partners. You get your preferred returns. And we share some of our profits with local charities. Oops. So working with an expert makes life a little bit easier. So let me break down the different roles here. So you'll be a limited partner. So you'll choose if you want to invest with us or not. You'll decide how much cash you want to invest, and then we'll send you quarterly progress reports, both in the form of a webinar as far as a written report. You can choose which is better for you, and you can just spend the money and enjoy your lifestyle. I'm one of the general partners, so I examine the local and national markets. I try to figure out where are the best opportunities to invest. I try to figure out which asset classes make the most sense in this phase of the economic cycle, and we figure out which sponsors we want to work with. That's kissing 1,000 frogs in the pond to find the right one. We negotiate the terms to get the best deals for you and I. And then we do a lot of due diligence on the sponsor. And then we usually will visit the site in person, look at the competitor sites to make sure that we like the valuation they've come up with, do all the regulatory compliance, figure out all the tax optimization, do all the reporting, and are accountable to you to provide those quarterly reports. So that's what we do. Then we are providing cash to a project sponsor in the vast majority of the cases. Every once in a blue moon, we'll be the sponsor ourselves, and we'll always disclose that. But usually, we're working with a local expert in that market who's got great local expertise. They are putting their own cash into the project as well. They guarantee the loan, so they're on the hook if anything goes wrong. And they're looking for capital partners just to bring cash, and we're one of those sorts of people. They're the ones who are day-to-day on the site, actually doing all the heavy work. Okay, here's the investment team. Brent Geyer is our CEO. He's got over 25 years of real estate experience. He's been a landlord. He's managed property managers, and he's got a very high track record for internal rate of return. That's IRR over his 20 years that he's been doing this. Richard Landry was at Goldman Sachs. He's one of quantitative analysts there and used to run a large family office of over $2 billion, building their portfolio. And I've worked in strategy consulting for 8 years at Deloitte and then Accenture. Then I've been in real estate full-time for over 20 years. I've done a lot of commercial development. I've turned around a lot of office buildings and apartment buildings. I've built a lot of houses. And I also built a large brokerage company from scratch. And that was really beneficial. Owning and growing a company to be the largest independent in Colorado, we had over 750 agents doing over 5,000 deals a year. So I had a front row seat to anywhere between 800 and 1,000 commercial transactions per year. And got to have a really good sense of what looked like it was going to be a good deal and turned out to be a good deal, and things that looked like they were going to be a good deal that turned out to be a disaster. And I've really drawn a lot on that expertise over the years. I sold that company to a private equity firm a couple of years ago, and then I launched this company, Ironton Capital, right after that. Separately, I'm on the board of directors for the Denver Zoo, the Boys and Girls Club, and the Ronald McDonald House. So, what should you expect from the fund? It's about a 16 to 20% target IRR. That's not guaranteed, but that's what we're hoping to accomplish. We're thinking it's going to be 4 to 6 years that you'll be invested with us. We do have the option for some extensions if needed, but we don't want to do that unless we have to. You won't have any liquidity on this. There is an option for accelerated depreciation for a tax write-off, and I'll talk about that in a bit. So every one of our 4 diversified funds is diversified in 4 important ways. And our first priority is the preservation of your investment capital. And then we want to try to get a good rate of return from that. But we are not here to get the very highest return by taking more risk. I've got a lot of my own money in this. I need the money back, and I assume that you're probably in the same bucket. I don't want to make overly risky bets. So our goal for this fund is that we'll be in more than 10 states. We'll primarily be in multifamily. Historically, over multiple business cycles, what you'll find is that multifamily has the lowest returns of all the different types of commercial real estate, but it also has the least volatility. It's the least likely to lose money. We will put a little bit into industrial and warehouse, hospitality, and we'll talk about some secondary credit here, which is something new for us, which we're very excited about. Actually, that started in Fund 9. There's 3 broad strategies that you could take advantage of. One is to do buy and hold of a nice asset already in great condition, already cash flowing. So it's very steady, very predictable, very, very low risk. We don't do any of that. If that's appealing to you, you probably want what's called a real estate investment trust, and they are really good at that structure. The second big strategy is value add, and that's where you buy an asset that's been neglected, beaten up, and the rents are far below market, and you can go into, let's say, an apartment building like that, spend $10,000 or $15,000 a door, and raise the rents by $400 or $500. And those types of products we really like because if you have a high degree of expertise, they are not much more risk than the simple buy and hold, but they have about double the potential return. And since I've personally done a lot of that, Brent's done a lot of that, that's an asset strategy that we really like a lot. Then the final one, that's a broad one for real estate, is a new construction project. And I've done plenty of that myself. Brent's done a lot of that. So that's also one that we feel very capable of assessing, so we can bring you good opportunities there. Those are a little higher risk than the buy and hold, and they have proportionally larger returns. And then opportunistic, we'll talk about that in a couple examples here and there as well. We'll probably pick about 10 sponsors. Some of our sponsors, when we make an investment in them, it'll just be in one asset in one location. Some of the sponsors will be in as many as 24 assets in, say, 6 different states. So our goal is collectively across the entire fund to be in about 30 different buildings in about 10 different states to maximize the diversification. And what we've usually found in the past, like on Fund 1, for example, we made 8 investments, and each of them were just a single asset, so there was just 8 properties in there. And one of them was an office building that we bought in the business district of Houston right before COVID, and we lost everything on that. It was a total disaster. And then we had one project that was a home run and one that was a grand slam. And the other projects like they're tracking to be just base hits, which is fine. So we're still going to probably have a 15 or 16% return on Fund 1, despite the fact that we lost everything on one of them. And that just shows the power of diversification. So the lesson from that from us is that 8 buildings is a great start for diversification, but 30 or 40 is a lot better. So here's our track record. These show you the target internal rate of return after all fees. And you can see where we've been at over the years. Got over 20 funds, if you can believe that. So these are the initial seed investments that we think we're going to have in Fund 10. So a lot of new build and value-added projects. So something very important for you to know is that a lot of investments of this type are called blind. And what that means is that you're going to commit the capital, you can't get it back, and yet you don't have a whole lot of insight into what the fund is actually going to be invested in. We do not invest that way with you. I'm going to give you right now an overview of what I think is likely to be in the fund. It's not the full list because I don't know all of it yet. I won't know that probably until June or July. But when we identify the last project, I will do another webinar live so we can do Q&A going through every single project and why we're excited about it. And I'll give you a written report on every single project and why we're excited. And then you get 10 days to review that with your financial team. And if you're displeased with anything, you can cancel your investment, get your money back, you're out of it. No questions asked. You're going to be stuck with me for 4 to 6 years and these investments. I want you to be as excited as I am about these things. I'm really excited about all the investments we made in our last fund, Fund 9, and I'm off to a good start on this fund as well. So I want you to share my enthusiasm, or that's okay. We can let you out of it. It's not that big of a deal. Let's go through these projects one by one. So we think that you're going to have about $100,000 cash flow with a $100,000 investment in the first year, and that you'll probably have most of your cash back by 2029, and most of the profits will come in 29 and 30, maybe as late as 32. This is based on a relatively pessimistic view. I'm assuming that we have a recession of moderate severity historically at the midpoint of the fund, and that some of our projects, it will not be optimal to sell them right away, and we'll have to hold them on even though they're complete for a period of time to wait for a really attractive time to sell. And that's why this timeline looks as pessimistic as it does. The reality may be that it might be we don't have a recession. It's going to be a really good seller's market in 2026 and 27, and that this fund could largely be wrapped up in 36 to 48 months. I don't know yet because I don't have a perfect crystal ball. So I'd rather have you plan on a more pessimistic set of assumptions. So this is some of the places where we have invested in so you can see just how geographically diversified we are. But it gives you a sense of the markets that we tend to really like. So the first of the projects I want to talk about is Hill Point. So if you think about the range of apartment complexes on the market, you've got properties that are for people who are economically challenged and they're on government subsidies on one end of the axis, and you've got really new ultra luxury properties on the other end. And in the middle, you've got workforce housing. So that's just for normal people like police officers and school teachers who don't get any government subsidy, and they just need a clean, nice, safe place to live. Hill Point builds workforce housing. So the vast majority of the new apartment construction going on in the market is the high-end luxury. Very little is in the workforce segment. So what we find is that since there's so little of this coming into the market, that there's a huge need for it. And if you place a new workforce sort of housing in a neighborhood where in a 2-mile radius you've got 4 or 5 other workforce housing projects, but they're all 20 to 40 years old, and yours is brand new and sparkling. It's not very hard to keep your building really full and get the rents that you want. So we've really enjoyed working with these guys. I've invested with them multiple times. Prior history suggests there's a lot more upside than the 17% conservative IRR that I've got in here. So the thing that really makes it work is they've got a highly standardized product. They build 2-bedroom, 2 baths in one configuration only. And then it's like Lego blocks. They stack them in 12, 24, or 36 per building. And they build a community, usually about 300 units with a swimming pool and a clubhouse in the middle. Every single one of their projects looks exactly the same. And since it's so highly standardized, they've gotten ultra efficient at building these things very cheaply. The vast majority of the things that can be sourced in China are bought directly at the factory. So, for example, many of you might be familiar with luxury vinyl tile. It's a great product that you can put on the floor, wears really well. They can buy it for about 20 cents on the dollar of what it costs for you or me to go to Home Depot to buy it, because they're getting it direct. Just one example of the stuff that they buy. So this has historically been an absolutely fantastic sponsor for us. Here's an example of what it looks like, although it is not deluxe. I mean, there's not like a dog spa here. You can see that these kitchens have got quartz countertops, stainless steel appliances, tile backsplashes. They're tall 9-foot ceilings, the LVT floors. It doesn't really come across so clearly on this, but there's a lot of cabinetry. There's a lot of storage places. The closet sizes are really big. These are the types of units you can move into and you can really be comfortable and stay put for a while. From the amenity package, they've got great clubhouses. I mean, they're not fancy luxury ones, but they're more than adequate for the market that we're trying to serve. And nice pools and gyms. So PFD is where we'll store the cash. So when you fund this, you can fund it all up front. A lot of our competitors may draw 25% of your commitment over 4 draws over like a 2-year period, which means you're constantly writing checks and you got to do something with the money until we're ready for it. Our approach instead is that we draw all of your capital. If you commit 100, we're going to take 100 on day 1, and some of the money we won't need right away. Hill Point, for example, will usually start 3 apartment complexes each quarter, and they'll try to build about 24 of them in a fund. So it's going to be over an 8-quarter period roughly, where they're drawing about 12% of our commitment to them every quarter. So to get you out of the headache of writing all those little checks, we park the cash partially in the short-term income fund, which makes 8 or 9%, and partially in PFD, which is our medium-term income fund, which makes about 13%. So we're earning a lot of interest while your cash is waiting to be put into, say, Hill Point to launch the next project. We'll also put in, it depends on the size of the fund, probably somewhere around $250,000 to $350,000 into PFD in addition to that. And that's for the expenses that the fund generates. Rather than having to send you an invoice every quarter and you've got to send us a little check, we can just draw it out of PFD so you don't have to bother with it. Finally, if one of our sponsors has a small capital call, this has happened a couple times over the years, we've got some cash on hand to be able to write a check for it. So that's what PFD is here for. It's our medium-term income fund. NPL, or Constitution Lending, is an opportunistic player in Connecticut, and I really like these guys a lot. So they are only in Connecticut. They have a pretty good-sized network of a commercial property management firm. So they've got the leasing agents, the maintenance guys, people who shovel snow, all the things you need to do to run an office building or an apartment building in Connecticut, in a couple of locations scattered across. Connecticut's not that big of a place. They've built an artificial intelligence engine that scrapes all of the judicial websites in Connecticut looking for postings from lenders for a borrower of a commercial asset that has gotten behind on their loan. And there's a couple steps in the process you have to go through before you can go to a foreclosure. So what these guys are doing is they're building a distant early warning system to identify commercial foreclosures. The great thing about their network across Connecticut is that they can pretty well tell, all right, I know this apartment building is a mile away. The one that's got the distress is a mile away from one that we've been running for a year. And we are friends with the people who run that building. Let's find out what's going on at the building. And sometimes these buildings have just been neglected and there's a lot of upside that wouldn't be difficult to, capture. So then what they will do is they will approach the bank and say, look, it looks like your building here is behind on their loan. Looks like you've posted it officially with the courts. It looks from your filings that they owe $5 million that they're severely behind on. $5 million with all the fees and other expenses for being late. We're not going to negotiate with you and try to get this for $4 million. We're going to pay you the full $5 so you don't have to take a loss. What we'd like in exchange is for you to give us really favorable terms for buying this loan from you. We'll complete the foreclosure and we're going to take over this asset. So the initial owner is completely wiped out of all their equity. They're getting the asset for a really good price, and they already know they've got upside because they already know a lot about the building. It's a fabulous strategy. I wish I could find someone like them in every single state. We're in the process of trying to do that. Okay, CVC multifamily. This is going to be building a couple different assets in multiple states. They're manufactured home communities and some self-storage. So let me show you what that looks like. So the center top and the top on the right, you can see some of these self-storage facilities that are pre-manufactured, and on the other rest you can see these are just mobile home looking things that are permanently affixed to the ground. So they're cheap to build in a factory. So what the sponsor wants to do is acquire and repositioning manufactured home communities that are underperforming and have been mismanaged and turn them around. So their stated holding period is 6 to 7 years. We're anticipating, based on some of their prior track record, that they're going to go a little faster than that if the economy allows us to do so. Their background, they've got over $500 million of assets, 110 of them of these communities, and 26,000 units across 29 states. So really, really strong track record with this. I'm pretty optimistic. All they have to do is repeat what they've done in the past. Wolf House is a local to Denver, if you're here in Denver with me, developer. And what they like to do is buy slightly oversized lots that can be legally divided in half. And we're looking for situations where the zoning for that's already in place, so we don't have to ask city council for a favor. It's an administrative thing they have to do for us because it's zoned correctly. And they build a small single-family home on each side of the lot. So here's some examples of some of their recent projects and the interiors. There's really pretty projects, and we picked neighborhoods. So if you're from the Denver, Berkeley is probably where they're going to be doing the ones that we're investing in, and they're pretty easy to sell at the back end. Pretty straightforward, really nice one. RPM Living. So these guys build large apartment communities, and you can see they build things that are pretty luxury, sort of the opposite of our first one that we talked about, Hill Point. So 5 or 6 years, building several communities, expecting somewhere in the 16 to 18% range on our IRR. So this sponsor is vertically integrated, so they do acquisition of land, they go through all the entitlements, they develop the project, and then they know how to run it once it's been completed. So they've acquired and managed over 40,000 units in over 100 communities. So really deep experience. And this one is called Waverly on the Lake. And this project is a large multifamily complex on a gorgeous lake in Michigan, not too far outside of Detroit and Ann Arbor. And a lot of the units have not been renovated yet, and the rents are quite a lot below market. The seller was someone who had had this in their family for quite a long time, and they had just kind of lost interest, as a lot of the owners who have been in a property for a long time often will. So the idea on this is that we're going to own this for probably about 5 years, and we conservatively expect it's going to be about a 16% rate of return annually to those of you as limited partners after all the expenses. So there's just over 1,000 units. It's about 100 acres with 40 buildings, and they're going to be doing a renovation of the units so they can justify a rent increase. And they've also got a grant from the local utility to swap out to more efficient HVAC systems. So it's going to be a very nice property for the residents as well when all this gets done. So for those of you who like depreciation to offset your capital gains in other investments, this is expected to generate a fair amount of depreciation in its first year, and that will all, of course, get relayed over to you as a shareholder. So this one's going to be called Echo Suites. This is a new extended stay hotel which is offered by the Wyndham master brand. So Echo Suites is one of their sub-brands. So we like hospitality in general and extended stay in particular, and particularly the economy segment of extended stay. And the reason for that is that just about 20% of the overall room nights in America are extended stays, and that means 7 nights or more. And that's when a person might really like to have a refrigerator and a small kitchen and a laundry somewhere in the facility, because it just makes it a little bit easier as opposed to a transient person just there for a night or two. And the amount of room capacity in America for this type of guest is around 10 or 11%. So there's a fundamental supply-demand mismatch between a lot of demand for this product and not a lot of supply out there. So we really like to be part of the development of new hotel projects like this. So what drives people to want to stay in a hotel for more than 7 nights? Well, a lot of it is not elective, and it's not really contingent on having a solid economy. So when you run a resort that's luxury focused during a downturn, sometimes people won't go to the most fancy resort, even though they used to be able to afford it. They'll trade down to something smaller, or maybe they just won't take a vacation at all. Similarly, a lot of companies have large meetings and conventions at big fancy resorts, but when there's a downturn and belt tightening, one of the first things that will tend to go is travel. On the other hand, for extended stay, you remember last fall there was 2 large hurricanes that went through Florida, and there were electrical repair crews from the electrical utilities from many, many states that dispatched their linemen and other engineers to Florida for months to rebuild the electrical system after the storm damage of the hurricane. Those types of long-term stays are at places like this, and they're not elective. They've got to get done. Travel nurses are sort of the postcard image of someone who goes somewhere and stays for, say, 3 months, and they need something that's furnished and ready to go. What you might not know is that the medical community of people that travel like that is much broader than just nurses. There's medical students that go to a different university for a month to do a fellowship to learn a particular skill, or a research scientist that does a guest stay at a lab for several weeks, or other people in medical practices. Another common element that you'll see is someone that's moving from New York to Chicago, and they want to live in a temporary place for a little while they figure out what neighborhood they really want to live in, or while they're house hunting. Or you have someone who's built a house, they sold their old house, the builder promised it would be delivered on date X, and then they can't meet the delivery deadline. It's going to be a month and a half later, but the family's already sold their house, and they wind up here for 6 weeks. So what I really like about extended stay is that most of the drivers, they're not elective, and even during a recession, you'll still have these sort of things happening. So this is a location in Missouri where there's demonstrated demand for more extended stay. There's only a couple of competitors, and they're all quite a bit older. So when we deliver a brand new, beautiful product, we're going to be the obvious choice that people would want to stay at if they're all about the same size room, and they're all about the same size, same price, and they're all in a good location. So wouldn't you stay at the new one instead of the 20-year-old one? So we anticipate about a 17% rate of return for our limited partners on this project after all fees and expenses. So the status on this, it's right next door to the Branson Airport. Many of you guys are familiar with Branson as being kind of a hub of country music entertainment. The site's already been secured. It's fully designed. They've got approval from the city from a zoning standpoint, and the construction actually started, I believe, last month, with delivery in February of next year. So pretty exciting project, East X 59, and this is a new warehouse in Houston, right next to the Port of Houston. And I didn't know that until I researched for this project, that the largest city for international trade in America is not New York, it's not Los Angeles, it's not Chicago, it is Houston. And it's a lot bigger than the number 2 player, New York, by a fair bit. So this is very strategically located close to where a lot of that port clearing work takes place. So they're going to build a big, new, beautiful warehouse. The sponsor on this is called Provident. I've invested with these guys on many projects. My best project by far in Fund 1 was a project that they did, and I'm excited to be working with them again. I think this is my 6th project with them. Just a little bit about Provident. Over the lifetime of this real estate developer, they've built just under $6 billion worth of projects. They're currently managing just under $3 billion of them. And over all the decades of their experience, they've built just under 15 million square feet of industrial space. So most of that's been in the Texas market. So they know Texas really well, and they certainly know industrial like the back of their hand. We're anticipating that this project will be about a 19% annualized rate of return. The sponsor built the project on a 5-year hold. I think it'll be closer to 3. I've done other industrial projects with Provident in the past, and we haven't gone past 3 years on one of them yet. If that's the case, the rate of return will be significantly higher than indicated here. It'll be breaking ground next month. They've already got all the design completed on this one, and it's in a really great location on a very busy highway, which of course would be very desirable for the end user on it. 62-acre site, 700,000 square feet. So if you guys have seen the really, really large warehouses like an Amazon or like a Target distribution center, those tend to be just at about 1 million or slightly over. This will be just a little smaller than that. What's important about this is that it's actually 4 different buildings. So the very the very large market for warehouses is a little bit oversaturated, but this mid-size market of like 180, 200,000 square feet, in most markets there's not enough, and in this part of Houston there isn't. That's why they specifically designed the building to fill a hole where there's demand from tenants where it's not being met. So should be a great project. Eagle 35 project. So this is a new warehouse that we're going to be building in Round Rock, which is sort of the tech hub suburb of the Austin market. So the Dell headquarters is there, and you can see on this chart there's just a litany of other very large companies with big operations in this market. So the sponsor on this is a group called Provident. I've invested with them numerous times in the past in Fund 1, and they're right on track for Fund 4 to be Fund 1, my best investment in that fund was a Provident project. Fund 4, it looks like my best investment in that fund is also going to be a Provident project, and a lot of the other ones have been great as well. A little bit about the sponsor. They've built just under $6 billion of real estate development over their entire lifespan. They manage just under $3 billion of assets, and they've built just under 15 million square feet of industrial space. So I like these guys as they're Texas specialists. They know a lot about industrial. In my prior industrial investments with them, most of them have wrapped up in about 3 years, and they've blown by their internal rate of return projections every time. This one is projected to have a 15 IRR. Based on prior work with the sponsor, I'm expecting it to be better than that, but we'll set our expectations low just to manage expectations here. They'll be closing on the land next month in April, and we should be up and running here sometime in about a year. So very exciting project, Square on 12th. So Square is the name of the developer. They do urban infill condos in the Washington, D.C. market, just a little bit outside of the core of D.C. that you think about with the White House and Congress and all the fancy monuments. So in an earlier fund, in Fund 8, we invested in 2 of their projects, and this is just a rinse and repeat of a very similar sort of a game plan. So this is on 12th Avenue. And I got to go visit this myself in person a couple weeks ago. So the outside framing is largely complete. You can see that there's these beautiful 2-story atrium, which isn't something you usually find in a condo. And then the finished photos here, these are from our actual investment in Fund 8. So those are just about finished and will be coming to market here shortly. So you get a sense of kind of what the finishes look like when we're done. So I put on here a 30-month hold, and I based the 20% rate of return projection after all expenses on that 30 months. I think it's probably more likely this is an 18 to 20-month project, but just to be conservative, I put in some padding, and we put in a little bit of padding on the construction budget too, just in case. As you saw, it's already well underway on the construction side. So it should be a great project. Investment we're calling the Missouri 4. So these are in and around the Kansas City, Missouri area. It's 4 different apartment communities that have been owned by a family for just under 30 years. So this is a LIHTC project, so it's a low income housing tax credit is what that stands for. So that is something that you can do when you're developing a project with the local housing authority, that you agree that you will rent out your units to disadvantaged people in the community that make, say, 60% of the area gross income, and you have a reduced rent that is subsidized by the government, and in exchange for that, you get a whole bunch of tax breaks. So if you do a LIHTC project, you make a 30-year commitment that you'll honor that, and after the 30 years, then you can do whatever you want. We're, I think, at 29.7 years into that 30-year agreement. So the building, these are actual photos of the property. Some of them have been renovated, and they've all been kept in really good condition. So it's not going to take a whole lot of renovation on this to get it to market. A lot of the units are already there. So the plan is to let the LIHTC contract expire, and they're not going to renew it. And then what they're going to do is position this to be on market rents, which are several $100s a month higher than the rents that we're getting right now. But we're buying the project on the economics of LIHTC. So we're paying $48,000 a door. If you can comprehend that, if you're in Denver, it's like a fifth of what a building would cost here. And do just enough cosmetic renovation to raise the rents to market, and then sell it at $92,000 a door. So this sponsorship team has done 45 renovation projects that look a lot like this. Most of it's been in Missouri. They've done similar projects, similar game plan. This one's written out as a 5-year project with a 17% rate of return to the limited partners after all expenses. I do think that this will probably go a little faster than that, and that the upside will probably be a little better. We've got a lot of padding into this one. So very attractive portfolio of 176 units, and I'm glad that it's part of our Fund 10. So those are the investments that we think will be in Fund 10. Some we've already wrapped up and committed to. Some we're in the process of negotiating on terms as I'm recording this today. So our target net return, to be conservative, is in the 16 to 20% range. We're expecting a 4 to 6 year life, some a little faster, some a little slower. If you need to have depreciation, then you want share class B. You'll get a 5% annualized preferred return, and the depreciation on the projects will be delivered to you only. Share class A will typically be for people investing in an IRA or a self-directed 401k, or maybe you've got a cash account where you don't need any tax write-offs. So you would be in share class A. You'll get an 8% preferred return, but you won't get any of the write-offs. So for those of you in share class B, a typical example would be you are currently an active landlord with a 4-unit property. You're tired of being a landlord. You want to sell it. You're going to recognize a capital gain as part of the sale process, and you'd rather manage the taxes. We can deliver the depreciation to you. Talk to your CPA, but in every case I'm aware of so far, the depreciation we generate can be used dollar for dollar to offset the capital gain. I can model this for you. I've done over 100 of these already. So if you're in that situation, set up an appointment with me. I just need a couple of variables about your property. I'll help you estimate your capital gains. Obviously, your CPA will be the final authority. And I'll show you a couple different options about how you can maximize your family's wealth. So how does the profit work on this? We don't have a catch-up anymore. So what will happen is, the first thing that happens is you get paid the preferred return. Then 72% of whatever's left over goes to you, and 28% goes to us, until each individual project has achieved a 20% annualized return. For the projects that do better than 20%, after that, the split will be a 70-30, 70 to you. If we have the occasional project that does more than a 30% return, that last little bit would be a 60-40 split. So it'll be, it works out to an 80-20 on the first 20%, a 70-30 to 30%, then a 60-40 after that. This is very typical across the entire private equity industry. We just kind of copied everybody else. We invest with you. The one-time acquisition fee is $80,000. We're anticipating raising $8 million for this fund, so that works out to 1%. The SEC, the Security Exchange Commission, is our regulator, and they've encouraged us to go to flat fees instead of percentages, so that's why it's written like that. The annual management fee is $160,000. That'll work out to 2% of the fund if we raise $8 million. And we may have an audit, and we may decide to do a few other things. If we do, we will let you know. But at the moment, we don't have any plans for those yet. A couple quotes from our investors. John said, before Ironton, the performance of my retirement assets had been inconsistent, even with professional management. I've moved my money from an unpredictable market, such as the stock market, to a fundamentally sound investment. You can read Justin and Tom. They've got similar sort of comments here. So I'm very flattered these guys would say such nice things, as well as commit their family's retirement funds to us. So we talked about the satisfaction guarantee. When we identify the final projects, we will give that to you in writing. You have 10 days to review it. If you're not happy, we'll give you your money back so you can be with us and really enjoy what we've done together. How do you fund it? Cash, self-directed IRA. You could get a HELOC and take a line of credit. against one of your properties. If you have an investment property with a lot of equity and you'd like to get a loan, a second mortgage, because you don't want to lose that great 3% you probably have on your first position loan, let me know. I've got some banks I can refer you to that might be able to help you get cash out from that. You need to be an accredited investor. So any one of these criteria will do the job. If you are single with an income of over $200,000, if you are a dual household income with over $300,000, or if you're investable assets, not counting the equity in your primary residence, if that's over $1 million, any one of those three things, you're accredited. So if you have any questions, you can go to irontoncapital.com/book now and set an appointment with either Nick or me or Evan or anybody else on the team, and we would be delighted to talk to you about any questions that you've got about what we discussed today. Thank you so much for your time.